Hello and welcome back to another video. I hope you're all doing well out there and that you've had a slightly better month with your portfolio than I have. It's not been a great month. We've had quite a few forced sales from hitting stop losses and things, so the portfolio has reduced in number somewhat. And yeah, it's been a bit of a correction month. Let's just dive straight into the stats as I normally do. Right. So yeah, in terms of the month, the portfolio is down 3.65%. Which obviously is quite a downturn, and that's mainly the market for the stocks that I've been invested in, so kind of more growth orientated stocks, has been difficult, especially in the US, and some of my heaviest weighted stocks have been hit quite hard during the month. So Meta, my largest position, took quite a hit, which has affected the portfolio somewhat. Which I'll get onto individual buys and sells later. But versus the FTSE, which was up 2.13%, it's not been great. And last month, the FTSE beat us as well. So I have been continuing to backtest and go over statistics and assess my strategy. And I'll come onto that more later in the video. But I don't think I've actually done a huge amount wrong this month. It's just one of those months where the strategy isn't going to outperform the FTSE All-Share every month, but over the long term, it should do. So it's not anything to panic about just yet, but there's certainly some things I can improve upon, which I will get onto further in the video. Next, we've got the year to date, which this is quite depressing to look at because we were up at 6% and the last couple of months, we've come down all the way to barely positive at 0.68%. And the FTSE's been going upwards, so that gap is widening. So I ideally want to start closing that, but as I say, I'm not going to drastically change strategies or anything. We're just going to ride it out and hope that the strategy comes good. With all the back testing I've done, there's nothing to say that it won't. And then the year to date, not year to date, sorry, total lifetime of the portfolio. So this is from the beginning of 2021, January 2021. We're up 13.16, and again, we've had a bit of a pullback in the last couple of months. We were up just touching 20%, and we've pulled back to 13%. But nothing too much to worry about. That's what I keep telling myself. And this is a review of the portfolio as it stands at the end of. So all of these screenshots were pulled on the 1st of May before trading opened. So just the final. At the end of April, effectively. So this is how the portfolio stood then, which I think it's the same now, a few days later. So we've reduced positions from 19 at the end of March to 15 now at the end of April. So we've cut quite a few positions. I've ordered them on this column here. I don't know if you can see that with my mouse in percentage gains that each position has. So Meta is still the largest. You'll see that the size of this position has come down. I'll get onto that in a bit. We were up. I don't know if my partial sale will have affected the percentage gain. I don't think it will have done. We were up. I made a Twitter post about it. Just touched over 200%. It was my first ever 3-bagger in stocks. I've had multi-baggers in crypto and other investment things, but never in stocks before. So my first 3-bagger, which was quite good. Obviously, I haven't locked it in, so I don't know if that technically counts, but we touched it momentarily. And I did a partial sale on Meta, which I'll come into later. But, I mean, in terms of gains, the portfolio is doing okay. If you look at that spread, I mean, ignore Impact's asset management down here at minus 29%. That's an anomaly. But more in the green than the red and some decent size gains towards the top. So not too bad. So that's a quick run through of the stats for the month. And now I'll get onto individual buys and mainly sales that have been made during the month. Right then, so I'll start with the buys. I think I normally start with the buys. So there have been 2 buys this month. The first one is Alphabet, Google. And this was technically a new position to the portfolio. I did own it, and I mentioned in my last video last month that I sold out of it when it broke through my stop loss down here. And I was just waiting to re-enter it, and that came sooner than I thought it would. So it shot straight back up, which I think I mentioned in my last video that I was fairly sure when I sold here that it was a shakeout and it was going to pop straight back up. And obviously it did, but I can't be too hard on myself. That was my selling rules. My stop loss was around here, so it had fallen reasonably below my stop loss. It had closed below my stop loss and was still below my stop loss on the next day. So that's clear. According to my rules, I have to sell. I can't. If I'm going to test this system, I've got to stick to the rules. So I sold, and it was still for a profit. And then it rallied straight back up, and this area here, this level of resistance, became my new entry point, my new where I would re-enter. So if you look at it here, that was the high. So we were waiting for it to come back up and break through this line with volume. So it didn't take too long. It came up. If I punch in a bit on this day, it came up. The tricky thing with volume that I'm obviously finding as I'm going along is one of my criteria for buying is to buy on volume. But on the day, you obviously can't tell if there's going to be high volume by the end of the day. So I'm struggling with that slightly on how to actually do that. Because if it breaks through first thing in the morning, you don't know, unless it is incredible volume and is already above the average. You can't always tell if it's going to be above the average volume by the end of the day. So I think sometimes you've just got to use your intuition and just kind of go with it. But here it did technically by the end of the day have above average volume, which you can see down here. This white line is the 150-day average volume, broke through there. So I entered here. Has been bouncing along here, and then on earnings there was a gap up, and just because I think in a normal market conditions or the market conditions, a strong market, this would have just continued, kind of continued straight up, but because of the apprehension we've had in the market over the past couple of weeks, it's kind of come back down as testing. But everything is strong in my opinion with the stock. One thing I'm going to show this month that I haven't been showing is the snapshots I do. So this is the snapshot for this earnings, which caused this gap up. If I pull it up for Google. So you can see accelerating revenue up here and accelerating earnings per share up here. So that's the strongest situation for me with my fundamental setups in terms of earnings. It had a difficult period as a few tech stocks did back in 2022 with declining EPS, and since then it's been accelerating. It's been a really strong stock. The only concern for me is their guidance is actually for not negative growth but decelerating growth, so the growth is slowing down. But this earnings report was incredibly strong. If you want to read through my comments, you can obviously just pause the video and have a little look. I'm not going to read through all of the comments because I've got quite a few to go through. And if for those that don't know, if you're watching this video and you don't already follow me on Twitter, I do these snapshots for all of the stocks that I follow that are on my watch list whenever earnings are released for UK stocks and US stocks, and I post them all on my Twitter account, which should be linked somewhere on my YouTube page. I'll try and remember to put a link in the description below as well. So yeah, we entered there. And so obviously so far this has been going well. In terms of my entry size, one of the things I've realized, which I'll come on to with my sales, but I may as well go through it now because this is the first time I've actually done it, is I find it difficult actually to do follow-on buys. And I know that's a strategy that a lot of people say that you should do, kind of do an initial entry and then top up your position as it's growing. But I've found, and this is just a short period of time, so obviously in the long run it may well be a decent strategy. But I've done that a couple of times with a couple of stocks that I've been stopped out on. Had my initial entry, bought later on more strength, and then it's kind of come back down, and I've been confused as to what to do. Like, do I do a partial sale if it's stopped out on that buy, or do I just use the stop from the initial entry? And risk losing more than 10%. And I find the whole thing a bit messy, a bit muddled. So what I'm experimenting with now is just going straight in with a full 100% position size with my initial entry. So this entry here was 5% of my portfolio. So the intended position size I want for that holding, but instead of doing 2% here, 2% here, 1% here, I've just gone straight in with 5%. And I think that just makes everything clearer. The maximum I can lose, so this is my stop loss down here, which is 10%, and it happens to be on the 150-day moving average at that point. Happens to be on the 150-day moving average at that point. So the maximum I can lose is 0.5%, 10% of 5% of my portfolio on any one trade, which I'm perfectly comfortable with. I think that's fine. And it just means that my gains are magnified from the start as well. So if it goes up 20%, I'm making 1% of my portfolio instantly, rather than having smaller positions that take time to build. So that's my new thing. For new entries from now on, I'll be doing full positions from the start, as long as I can actually get that. I mean, for a sort like Google, it's not an issue, but for some UK small caps and stuff, I might not be able to get a full position size on the first day, but I'll try and build it as quick as I can, kind of thing. Right, next up, ResMed was the only other buy of this month. So this is a US pharmaceutical company. This was an existing position. I think I've talked through this before, but if I haven't, it was terrible entry. So this is before I've refined my entry strategy, my trading strategy. So this passed the checklist. It had the checklist score to buy it here, but this was back when I didn't really know what I was doing in terms of entering. I had a much more value-orientated mindset. So I had the mindset of, if the price is down, buy it. And I had like a value line that if it was below that share price, I saw it as good value and I would buy it. So I ended up buying a lot of stocks that were in major downtrends. And that got me into a bit of trouble. So now I don't worry about valuation. I just have the checklist score that the stock is a high quality company in my opinion, and then I wait for a good chart setup to enter. So this was terrible, complete downtrend, no way near any of the moving averages. This one's not as bad, so I waited for it to come above the 150, but it's still, so the past month I've been back testing loads of stocks. I talked about it in the last video and I'll talk about it a bit more later in this video, but through doing that I have gone through and like sims, basically, they're not real trades, but I've simmed thousands of trades. So I've really refined my entry strategy and what I should be doing, and this I wouldn't actually do now. The 150 is in a downtrend, which is a no-go. It wasn't actually breaking through any major resistance. The major resistance is up here until this kind of came down and created resistance here, because there wasn't a clear, this was more of just one general upslope. It's not the worst entry in the world, but I wouldn't do it now. But then this came down and it kind of traded in this sideways action, creating a clear resistance line here. And then on earnings, it bounced up and I managed to get it kind of in the middle of the move for the day, just to top up to this. So this is now a full position. So this was probably like 1% of my portfolio, this actual buy, but topped this up to about 4 to 5% of the portfolio as a position. And this was on very strong earnings. I'll show the earnings snapshot for this one, ResMed. So not accelerating revenue, but it was accelerating EPS from a negative the previous quarter, so a strong improvement. And the revenue guidance for next quarter is to accelerate, and for EPS to continue to accelerate. I haven't put the decimal places in here, but it technically is. This is like 28.9 or something, and this is like 29.3. So it both accelerating for the next quarter, which is also something I look at, because obviously that's a strong indicator for forward growth. And again, read through the comments if you like. So this here, I'm very happy with this entry. Strong earnings, strong breakthrough of this kind of prior resistance on huge volume. Happy with that. Even if that fails now, that's okay. The setup was following my rules. The moving average was in an uptrend. It ticked all of the boxes, so I'm happy with that. And then in terms of sales, we've had a lot of sales. The first one I'll come to, because I've touched on it already, is Meta. So this didn't hit a stop when I sold. So I sold here. And this, you can see it had some apprehension in the stock anyway. A lot of people, and I think institutions and things, were locking in some profits around here because this has had this huge run up. And then, so there was a lot of sideways actions here. There was sideways action here for a while, but it hadn't had such a big run up then. So I don't think people were as conscious of taking profits. And then it had this continuation leg and has been going sideways again. So I was umming and ahhing about what to do here because I don't have any set rules yet on what to do if I have like a large profit, like 100% plus profit on paper. Like what to do in terms of taking profits and when I should be doing that, apart from if it hits my stop loss. So it was the day before. The market was very apprehensive, kind of across the board. Everyone was worried about earnings. And I figured even if for Meta to go up, I thought they would have to absolutely crush it on earnings, like exceed expectations by a mile, have forward projections of a mile. And I thought the chances of them doing that were slim. I thought they'd have solid results and I thought they would beat expectations, but I didn't think they would completely knock it out of the park. So what I decided to do was sell a third of my holding before earnings, so that if it did drop down kind of 10 to 20%, I'd be kind of disappointed, but I would have locked in profits, so it wouldn't be the end of the world. So I sold a third of my holding here to lock in some profits. They did release good results, so I can go show the results on that as well. So accelerating revenue, which beat expectations by a marginal amount, a couple of hundred mil a marginal amount, but yeah. EPS was decelerating, but it was still up 114% year over year. So really, really solid results. But the thing that made it drop was that Zuckerberg on the call was just talking loads about how much money they're going to be investing in AI over the kind of next couple of years, and it's going to take time for them to start making any kind of noticeable profits from it. And that's basically all he talked about on the call. So that just got everyone worried. Not necessarily worried, but it's just the CEO is saying that they're going to be investing huge amounts of money and they're not going to be seeing any profit from it for years. So obviously that's not the strongest sign for the near-term performance of the company. Everything else in the company is performing really well. The core fundamentals of the business are performing really well. All of their kind of Facebook, Instagram, all of their core advertising business is performing well. It's just that spooked quite a few people. So it did drop just over 10% on the day after earnings, and it did come down kind of 15, 16%. Has since started coming back up, and it's still, I think it will continue its uptrend because it's still beating earnings and putting out really decent growth, especially for the size of company that it is. But I'm happy I did that. This stop line was in before, and this was where I'd already decided if it went through there, I was going to do a partial sale, and this was my overall stop following the 150. Which has been raised once it bounced back off here. But I sold here, so I didn't have to sell here. So I saved myself a good 10, 15%. So I'm very happy with that. That was the right call in hindsight. If this does turn over and comes down through this stop here, then I'll sell the rest of my position. I'll be fully out of Meta. But because they did put out such good earnings, I do anticipate this is going to maybe trade sideways for a while, but then continue upwards, and I'll have 2/3 of my position left to carry on with that trend. I don't think I would add to my position now. I'll just let it run. So that was Meta sale. So even selling a third, it had come down a bit from March. And then it was even selling a third, it was still my largest position, and we had this big fall. So that's one of the contributors to the poor performance of the portfolio this month. Right, Adobe is out. What have I written about Adobe? Yeah, so this gap down. So we bought back here, which, to be fair, that as an entry, I'm completely fine with. It was going sideways, multiple touch points. It broke through. It had volume. I bought on the day. As an entry, perfectly fine in my opinion. Went sideways, and my initial stop would have been down here. Maybe if that's less than 10%, it would have been. I know it would have been a bit higher. It would have been at 10%, so about there. But then when it came down and bounced back up, I would have moved. So it would have been down here somewhere. I then moved it up to meet the point where it came down and went back up. And then here, so maybe I should have sold here, but my rule is it has to close below the stop and then see how it reacts the next day. So it didn't actually close below my stop line on this day. It went below, but then it closed just slightly above. The next day, it was doing the same thing and closed very, very slightly below. So I was like, well, I'll just, if it continues to go down the next day, I'll sell. But the next day it went back above. So we're up above. And then on earnings, it gapped down. And that there's not much I can do about that. So there's a big gap down. I didn't sell on that day again, because I was like, well, normally there's a bit of a rise after that. It carried on up. I was thinking it might come all the way back up, so I didn't sell. So maybe I should have been, really, I should have just sold then. That's my rule. It's gone down, sell, get out. And then it went sideways for a while. I was like, no, what am I doing? It's not showing any strength to come back up. So I sold here. And that was for it's like 17.6% loss, but an 18% loss effectively. And I don't think there's much I could have done different here. That's perfectly fine with my rules to not sell there, because it was only technically below here, and then it went straight back up. Actually, that's technically below, isn't it? But so yeah, probably should have sold there actually. But then this was a gap down. And there's not much I can do about a gap down. But one of the things I've been looking at, so I'll keep going through my sales in a second, but there was a lot of sales this month. And I obviously down quite a few percent for the month in terms of the portfolio. So I was like trying to figure out what I could change to improve my results. And one of the things, so it wasn't the case with Meta, but for most of the stocks that I've sold, this is the case, that the earnings from the last results weren't great. It still passed my checklist, but the earnings of the most recent quarter weren't good. So this is for Adobe. Negative year-over-year EPS, declining revenue growth. So still 11% gain year-over-year, but declining from what it had been. It had been accelerating for 3 quarters and then declining, and forward guidance to decline, and negative 50% year-over-year EPS. So this is what caused the big gap down. So in this situation, there's not much I could have done. But there's other stocks where I have bought after the red earnings, which I shouldn't do. So that's a new rule. So let's get on to the next one, YouGov, which is a UK. So YouGov is one where I could have got out a lot sooner than I did. So YouGov is an awkward one. So I owned back here. It was in this, you can see there's kind of like a kind of loose trading channel here. I owned during this period. I got stopped out when it broke down here, so I sold. It came straight back up. The earnings were after I got stopped out, straight back up. And I re-entered when it came into the channel, because it's not one I use often. And to be fair, in fact, I very, very rarely ever use that method of entry, and it doesn't actually pass any of my rules. It's just, I think it's because I felt a bit aggrieved that it had just kind of shot down and shot back up so quickly that I kind of, and this is what you should never do in investing, I kind of wanted payback. So it was a technical indicator that some people use, shooting straight back up into the channel. So I re-entered, and it actually turned out to be a good move. Carried on up. I added to my position here on this strength where it broke back up past this level of resistance, and then it's kind of been going sideways and has fallen down. But both of those should not have been an entry. Once I was stopped out here, it should have been this, at least this previous level of high, but probably this, the trading range I showed, should have been this across here, and I should have waited for it to break through that. You can see I've got the line over here. I don't actually need that line. waited for it to come back through here. So these, I never should have bought here and I never should have bought here. I should have waited for it to break through this line, which was the previous high over here. So I never would have been in the stock. I still wouldn't be in the stock. This fall wouldn't have affected me because I wouldn't have had a holding. But I didn't do that. It has fallen. But one thing I could have done is back here. So on this day, these earnings were released, where it was a 74% decline year over year in EPS and only a 9% revenue growth when it has been 28, 31, 30. Forward guidance is for 33, but this was not a good set of results. So it's kind of been a semi-rule, but it's now a hard rule. If I own a stock and it has declining EPS or revenue, not declining, negative EPS or revenue, if I own it, I have to sell it. And if I don't own it, so if it's on the watch list, I can't buy it if it has negative of either of these two. I have to wait until it's actually growing. So I would, with that rule, I would have sold here and saved myself an extra 12%. As it was, I didn't. I waited for it to come down to my stop and sold a little bit below my stop, to be fair. And that, because I'd bought back down here, it was actually only a 3% loss. But the really painful thing about this is from here up here, I was up 43% on my initial buy. And I've come back down to a 3% loss. So that's why I'm also looking at taking partial profits like I did with Meta, but maybe on a smaller scale. Do I take something at 20, 25%? Or I don't know. That's one of those things. I think sometimes you just have to accept that that's going to happen. But I could have got out a lot sooner and still had 10% or so profits. So Doximity. Again, this is one that I'd owned for a little while. Similar to which I can't remember which stock. Oh, ResMed that I was talking about earlier. This was before this was just buying on valuation terms. So I was buying when the price was low. I wasn't paying attention to if it was in an uptrend, any of that. So buys all over the place on low points. And then here is when I actually started implementing some kind of entry strategy. I purchased when it came up through the 150. But again, now, quite a few months later, with a refined strategy, I wouldn't have entered here. The 150-day is in a downtrend, which is a no-go for me, and there wasn't really any volume. So that wouldn't have been a purchase. And then, so I basically just got stopped out of this. My stop loss was here. It's continued down, and I've got stopped out. So poor entries here, basically, and got stopped out in the end. And because I'd been buying back here, it was quite a considerable loss on this one of 16% loss. So going forward, I shouldn't be getting these because I've still got left stocks like this that were entries before I had my strategy that I've got now. So there's going to be, as these kind of either sell at a profit or sell at a loss, there's going to be some 16, 18% losses where my strategy just isn't aligned with what it is now. But going forward, any new entries, there shouldn't ever be a loss of 10% or more unless there's a gap down, which I can't avoid. But the thing is with this one, it's actually had really good earnings. So the last time it had earnings, this was my old format for earnings. So earnings must be coming up soon. 16th of May, so in a couple of weeks. But this is my old format. But you can't tell as well on this one, but it did have accelerating revenue and EPS. So green across the board, yet it's still not performed well. So that's a little confusing to me. There is some other news going on with the stock, which might have an effect on it, but it just shows that there's no hard and set rule that's always going to be successful for you. So this has come down. We're out. No position in Doximity now, but it has decent earnings, so I'm allowed to buy it, and we're just waiting for it to come back up. So this is the previous resistance level. If it came up now through here, it would be breaking through resistance. It would be above the 150, which is in an uptrend. And if it broke through with volume, then that would be a buy, and we would go in with a full position, 5% of portfolio, and away we'd go, hopefully. Viva Systems, also a US healthcare stock. So this was the previous level here. It broke through. It had volume. The second day it had volume as well, but it kind of closed below. And it came back, so it closed below that day. It came back up through and I bought here, but really here it didn't have that much volume. This is one of those things you can't really tell when you're in it, to be fair, unless it's super volume. So maybe I just need to have a rule that it has to be kind of really high volume. But I bought here, so not the best setup, but also not the worst. But here's where it comes on to my new rule on earnings. So these earnings here, it's green on here, but that just means it beat expectations. So this was before my entry, just before. If we look at Viva, I even did the analysis on it. So this was for those earnings. Declining revenue growth, though kind of in line with what it has been, but negative earnings per share, down 22% year over year, when for the past several quarters, it's been accelerating or kind of declining, but still quite high. And this quarter, it was negative 22%. So I shouldn't be entering the stock. That should be red light, wait for the next quarter. If it's accelerating the next quarter, then okay, I can buy. But for this quarter, declining, no, can't buy. And that would have saved me this decline. So yeah, I wouldn't have been able to buy and I wouldn't have been in this. And then it just came down, hit my stop, and I'm out. And that was for a... that was for break even because I forgot that I bought back here. But if we imagine that was a new trade, that would have completely saved me. As it was, I bought back here. Again, the same as the other stocks. Before I had my entry system, buying on valuation terms, I bought back here. And to be fair, it had been doing well. And then I got stopped out here as I entered. So I'm out of that one. That was for like a very marginal gain. Plus basically 0%, but plus 0.18%. And I should say, with all of my percentage gains and things, because there's probably some people wondering, all of the percentages I say, they include trading fees and taxes and all of that things. That's all taken into account. So it's my net profit and loss. Right. We're almost there on the sales. One last sale, which was Pool Corporation. So I talked through this one, and I talked through my entry of this one in the last one, so I won't go over that again, but they're an American company that make swimming pools and sell all the maintenance products for swimming pools. Had a run up during COVID, decline after COVID, and it's been kind of in this sideways action. So there was this resistance line here. I entered very late. I should have entered here, but that's neither here nor there. It failed, basically. So in terms of the chart, the entry here, I mean, ideally it would have been on this day. There was nothing wrong with it, really. There was volume, albeit not huge, but it was above the average. Broke through this line. There's nothing technically wrong with that entry, really. It could be a lot better, it could be a lot stronger, but there's nothing technically wrong with it. And it just broke down through my stop. But again, if we go to Pool Corporation's earnings, negative and negative. And it has been, I mean, I've known this, I've been waiting for it. Ooh, what have I just done? Just underlined a load of stuff. And it has been for a load of quarters. I've known that. I've been waiting for the growth to come back. And when I entered in my last one, I think I said in my video, it's showing signs of that growth coming back, which it is, because forward guidance is for accelerating growth again, back to positive growth. But clearly from this, the market didn't like it. And if I had my rule that I can't enter if the current quarter is negative, then I would never have entered. And then I would wait for the next quarter. And if the next quarter is positive, then I can enter. So this earnings back here would have been this month. So this would have been the last one. And for that, the forward guidance would have been negative as well. So I definitely shouldn't have been entering here. This most recent earnings, which was just last week, is what this current one is. So negative, but with positive forward guidance. And you can see the kind of decline has steadied. So we'll wait and see. But no, my new rule is it has to be current quarter. If it's negative, I can't buy. So even if this now ran up, straight up through this line, I can't buy until the current quarter has at least yellow in these two boxes. It can't be declining. But this is what I'm assuming, what I'm anticipating is going to happen is it'll go sideways. We'll get to this quarter. It might even be up here kind of testing it. We'll get to this quarter results. It will be close to what they predict. It's like single figure, like 1, 2, 3% growth in revenue and earnings, and it will pop up, and then I'll enter as it breaks through here. So that's it for all of the buys and sales. So there's obviously a lot of sales. That's gone on for quite a long time, me talking through the buys and sales, but hopefully you found it quite interesting. And yeah, this is now, I've been doing these for ages, but I haven't, I'm using them more as a fundamental rule now. I've always kind of said to myself, oh, if the earnings are declining, then I shouldn't be buying. But it turns out that I have been. So I've made that a much firmer rule. Because if we look through here, Adobe negative, YouGov negative, Doximity was up, Viva negative 3, Pool negative 4, and these are both positive. But that's 4 out of the 6 sales I made were on poor earnings. So I might not have necessarily been able to avoid all of my losses, but I could have limited losses, and some of those positions I wouldn't have even been in the first place. So that's what I was doing this month. I was it's fine, it's investing, you're going to have down months, but I was a little bit like demoralized, a little bit miffed that I had such a poor month. So I was going back through looking to how to tweak and improve my rules, and I think that is one that will really help. But sometimes it's just, you just have a bad month, don't you? And the market conditions for my strategy haven't been great this month. Right, and then finally, so hopefully you've enjoyed me running through all the buys and sales. Finally, I haven't managed to do all of the testing for poor stocks to compare, but I have finished my testing. So let me start that again. So last month, I went through my testing of the last 10 years of stocks that were on my watch list, that scored 75 or more on my checklist. And they were very impressive results. And I said I was going to go back and test my keep an eye on stocks, and that's with a checklist score of 70 to 74. So still reasonably high quality stocks on my scoring system, but supposedly lower in quality than the ones on my watch list. So I went through, and this was only 33 stocks rather than the 50 odd it was for the watch list stocks. So admittedly, 33 stocks, that's a very small sample size. I get that. And I back tested for the last 10 years for these, the same as I did in the last time. So what was interesting though, again, very small sample size, I understand. But the average return for the 75 plus ones, the ones on my watch list, supposedly the higher quality stock ones, was 27.92% per trade. So still very, very good. But the average return for these stocks, the 70 to 74 rated, was 36.45% per trade. And through all of those 33 stocks, there was not a single one that over that 10-year period would have lost money. They were all profitable using this system. So I found that very interesting, and it made me think, well, why am I excluding them? Because I'm not allowed to buy them. With my rules, I'm not allowed to buy them unless they're at 75 or above. So it made me think, well, why am I excluding them if they're scoring high? And I was thinking, why are they high? And I haven't tested this. I don't know how to test this. But one of my theories was that they... so my checklist takes long-term things into account as well. So like 5-year average return on capital employed and 5-year average cash flows, 5-year average revenue gain, 5-year average operating profit. So kind of not hugely long-term, but reasonably long-term. And a lot of these are actually younger companies that are getting enough score in that to get onto the checklist, but they may have not been profitable 3 or 4 years ago, but now are, and that is affecting some of the metrics that goes into my checklist. So it's made me rethink that maybe I should be allowing stocks with a 70 score on. So this is my watch list, you can see you can't see. Let me make it so you can see again. This is my watch list US. So these are all the ones with 75 plus, and I've got the same for the UK, but I also have a keep an eye on list. So this is my keep an eye on for the US. So these are all stocks with score of 70 to 74. And I also have a keep an eye on for the UK, the same, 70 to 74. So you can see all the stocks in here if you want to pause and have a look. I tested all of these stocks. You can see on this, so this is Luceco. I back tested. I mean, couldn't quite get to 10 years because it only IPO'd in 2016, but I've back tested for all of these as well. So yeah, I'm not 100% sure, and it could just be the sample size. It could just be because there was 3 stocks in the watch list one, the 75 plus, that were negative for those that 10-year period, which would have dragged down that average percentage quite a lot. So it could just be I was unlucky in this sample size there weren't any, but if I extended it to 200 stocks, if there were that many that could get 70 plus, that it would lower that return. But I just found that very interesting, that for this sample size it was actually a higher percentage return per trade. And again, very similar, the US was more profitable with an average of 38.94% per trade. But the UK was still very profitable with an average of 33.07% per trade. So similar to the previous set that I tested, that they were quite close, but the US was more profitable. And then, so to average across, so all of the stocks that I have researched that have a score of 70 plus, so combine all the way up, so combining this set of testing with the testing I did last month. So this is 80 stocks tested, going back 10 years, if the stock's been around 10 years, as far back as I can go, if not. The average return per trade across all of those 80 stocks was 31.38% per trade. So that reinforces my opinion that the strategy works. I just need to really refine my entry and, like I've been going through today, not make silly mistakes and just kind of really dial in that process. So I have started testing. It's been manic the last month just with the amount of earnings. It's earnings season in the US, and I've just been stuck into earnings. That's what most of my time's been taken up with. I've stopped the testing, but I have started testing poor stocks. So fundamentally poor stocks that would be nowhere near passing my checklist. And I just did this by putting a screen into Stockopedia. I just did this by putting a screen in Stockopedia, basically for poor metrics, like lower than 0% revenue growth, lower than, I can't remember exactly what the screen was, but basically looking for poor quality stocks, just as like a test point to compare to my high quality stocks, just to make sure it's not a strategy that just works with any stock. And I've only just started testing it. I've only tested about 10 stocks or so, but so far the figures are far, far worse, as you would expect. Strangely, mostly still profitable over a 10-year period, but instead of it being like an average of 30% per trade, we're talking like an average of 5 or 6% per trade over a 10-year period, so nowhere near as profitable. But I am going to continue testing that because I want to make 100% sure that there is a general increase in the success rate as the quality goes up, because I need to make sure, to be efficient with my own time, that it's actually worth me researching stocks and having a checklist system and doing all of that, rather than just, I mean, it might not be, and it might be the case that I just become a full chartist and just have a screen for momentum and breakouts and just trade random stocks that are setting up nicely, which I know a lot of people do. But I've always been of the opinion that you're going to have better setups with a fundamentally sound stock. So I will update probably next month on that, because if I find some time, I will continue the testing of that. But yeah, to sum up, I am going to do a full video. The reason I haven't put the video out yet is because I'm still refining my process. But to sum up the changes this month, same setup on the charts that it has been. It has to be breaking through a prior resistance. It has to ideally have volume, if I can judge that correctly. It has to be, the 150-day moving average has to be in a sideways or uptrend. It can't be in a downtrend. So back here in this downtrend, if it had broken through here, I technically, let's put some pen. So if this had carried on and gone up through, I couldn't have bought here because the 150 is in a downtrend. So the 150 has to be either leveled out or in an uptrend. Nope. So it's the same entries I've had, but I have added that the earnings have to be not negative. They've either got to be green. So green means that they're accelerating year over year. Yellow means that they're growing. So it grew 6% revenue this quarter year over year, but it's less growth than the quarter before was. So that's my new hard rule. If it's negative, I cannot buy the stock. And if I own the stock, I have to sell the stock. So let me just show you one thing actually, which you might find interesting. So all of these earning snapshots, let me pull up a spreadsheet. Right, so I've not shown this before. I don't mind showing it. I don't think there's any reason not to, because all of this is I've posted. So this looks very confusing, but this is my watch list diary. So this is for me, really. But so if you see, you take a column. So this is for me to keep it. Basically, it's just these snapshots, but put into little squares, so I get an idea of what's going on. It gives me kind of a quick snapshot of what's going on with the stock over the past year or more. So each row is a stock. So this is Booking Holdings, this is Crocs, Deckers Outdoor, and each square is a quarter. And then in each one, so I can link. Here's my snapshot for Booking Holdings. My computer's very slow, but that would come up, and I can quickly go in and see what happened in that quarter. And I also have a link that would take me to, well, I can click it. That would take me to their actual form, their 10K, or whatever the appropriate document would be, so I can quickly get to it. But this just gives me a kind of idea of what's going on. So this is for the quarters, Q1, Q2, Q3, Q4, the current quarters. And then I'll put, once we get into a new year, I'll put the old ones here for kind of historical purposes. But it gives me a really quick idea of what's going on. So really, I should never have bought pool. I can see really quickly here, red. All across, red. Shouldn't be happening. Deckers Outdoor, green. And ironically, Deckers is doing really, really well, but it hasn't had an appropriate entry for me. And you can just scroll down and get a really quick indication of what's going on. You look here, Meta Platforms, green, 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 yellow on the most recent quarter. So that's why it's one of the reasons it's dropped a bit. But I just thought I'd show this because I think it's really interesting to see other investors' kind of strategies. And one of the things I really like seeing is like the inner workings of how they actually document things. So this is how I do it. And I've got the one this is for my watch list. I've got the keep an eye on stocks as well. And interestingly, there's more red on this. Well, there is at the top. And then I've got my UK watch list as well, which I format slightly differently because we don't operate in quarters in the UK. So I've got my H1 and so interim results and full year results of the current year, and then interim and full year of the previous year. And then I've got current year trading updates and kind of news, important news, and then just historical results going off to the right. But again, it just gives me a really quick indication. So if there's a lot of red around, probably not going to be a good time to invest. You see here's a sea of red in the financials. The financial sector hasn't been doing well in the UK. But when that starts getting some green, it's going to be more ideal to invest. And then it's just a very quick way for me to look through and see what's going on. So I thought that might be interesting to some people. As you can pause it and look at what's there, obviously, if that's going to help, or kind of if this is kind of the way that you think you'd like to work, you can kind of copy it if you want. But anyway, yeah. That was a long video. There's quite a lot to talk through there, but that's the main strategy change, is really paying more attention to recent earnings and actually using that as a true traffic light signal. Red, can't go. But yeah, that's the month of April out the way. We'll see what happens in May. But I'm enjoying the process still. It's disappointing to give back a few percent in 1 month. But I think in a way, it was kind of a cleansing month. It's kind of getting out all of the poorer trades. And I do feel more comfortable now and confident with the portfolio of stocks that I've got left, the 15 I've got left. I feel are it's basically the ones that are getting cut are the weaker ones, the ones that had poorer earnings, or the ones that I had poor setups in, and I'm getting left just with the stronger setups, the stronger stocks. And going forward, I shouldn't have, well, I will occasionally, but I should have far less poor entries and more kind of stronger setup entries, hopefully, going forward. Anyway, long enough. I've been talking for a long time now. If you're still here, then well done, and thank you for your commitment. I hope you all have a great month investing in May, and I'll catch up with you in a month's time. See you later.